Welcome back to the Value Investors Club. I'm your host, Timo Wunderlich. Let's get right into it with VIC Readings, the format where we look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have Nagano Keiki. Ticker is 7715. Price at the point of filing is 1,155. I'm assuming yen, because Nagano Keiki is a small cap Japanese manufacturer of pressure measurement instruments. This is not a recommendation, not advice. Please do your own diligence before investing into anything. And please write down in the comments below if you have invested, will invest, or why not into Nagano Keiki 7715. Although a small cap, Nagano has a solid competitive position as one of the largest pressure gauge manufacturers in the world with very strong brand names. The business has proven resilient through past economic cycles and is receiving a material tailwind from recent yen depreciation, with 50% of sales coming from outside of Japan. Despite a demonstrated business resiliency and strong recent results, Nagano trades at 5.6x run rate EBIT, 4.6 run rate EBITDA. These multiples compare favorably with Nagano's annual average TEV/EBIT multiple since 2016, which has fluctuated between 5.8x and 11.2x, with an average of 7.6x. Nagano's strong competitive position, resilient underlying business, and currency tailwinds and modest multiple expansion to closer to its average TEV/EBIT multiple of 7.6x will drive more than 30% upside to fair value by year-end 2023. Note, liquidity is fairly thin at 400,000 a day, so this idea is only appropriate for small funds and PAs. Business overview. Nagano is a leading manufacturer of pressure measurement instruments, pressure gauges, and pressure sensors. Founded in 1896, they have a storied history and have established strong brand names and customer history. Nagano focuses on higher specification applications where performance is often critical. Their instruments typically have less than 1% accuracy specifications, many times much less. End users of their products, e.g., refineries, petchem plants, automobile OEMs, semiconductor fabs, water treatment plants, etc., created accepted manufacturers list AML for pressure gauges sensors for brands. They have demonstrated their reliability and suitability for the application. It is not an easy thing for competing manufacturers to get on an AML. In addition to AML's, customer history/preference plays a large role in product selection. Engineers with a long history of successfully using Nagano's products continue to specify them in new projects because pressure instruments constitute a very small portion of the overall project costs, and reliable, accurate measurement is important. In addition, Nagano's large install base creates built-in MRO, maintenance, repair, and operations demand for their products. When a pressure gauge or sensor has reached the end of its useful life, the maintenance engineer will almost always order a drop-in replacement from the same manufacturer unless there was a performance issue. Their incentives typically do not encourage potentially jeopardizing process reliability in order to have to save small amounts of money. Nagano does not provide a breakdown of their business between MRO sales and new project sales, but we can summarize based on the stability of the revenues that there is a large chunk of relatively stable MRO based revenue. Looking back to the great financial crisis, a peak through revenue decline was 25%. During peak COVID year, 12 months ending 31st, 2021, revenues declined 9%. During both those time periods, Nagano remained solidly FCF positive. Nagano's business is not a high growth business. Total revenue has CAGRed at 2% since 2008 and 3% since 2016. However, EBIT has done much better, growing at 9% since 2008 and 11% since 2016, due to gross margin expansion from 23% in 2008 to 28% in 2022. Despite many attractive business characteristics, Nagano is still an overcapitalized Japanese company. ROIC has averaged 6% since 2016, and ROE has averaged 8%. While I do believe there is meaningful room to improve these numbers, my thesis does not count on significant changes in operational or financial strategy. Note, unless otherwise noted, all figures in tables below are in millions of yen. Industry exposure. Pressure measurement instruments are used in a huge number of industries. Some of the larger industry exposures include upstream, midstream, and downstream (O&G), with downstream being the largest. Petchem, water and water, semiconductor fabs, automobile OEMs, power generation, pharmaceutical slash biotech, food and beverage plants, pulp and paper mills, and large HVAC systems. These industries vary widely in their cyclicality as well as their MRO versus project based demand split. However, we do know that Nagano's overall revenue stream has remained fairly stable through recent economic durations. Below is the industry split Nagano provides. It is easy to note the 23% exposure to automotive products, 12% exposure to semiconductors, and 4% exposure to HVAC systems. HVAC systems. Oil and gas and petchem sales would undoubtedly be included in the 40% constituted by the industrial machinery and process product segment, with along with water and wastewater, power gen, and other process plant type applications. Segment breakdown. The table below lays out the segment versus segment revenue streams Nagano breaks out. Pressure gauges account for about half of their revenue. Pressure sensors account for another third. Both of these segments have CAGRed at 4% since 2018. In the most recent quarter ending 9th 30th 2022, strong oil and gas demand in the USA, good demand across most sectors in Japan, and currency tailwinds drove a solid year-over-year pressure gauge revenue growth of 22%. Pressure sensor demand was also solid across all fronts, but sales were hindered by continued shortages of electronic components, chips. Pressure sensor sales in a quarter ending 9th 30th 2022 were up only 6% year over year. As those shortages resolve, I expect pressure sensor sales growth to accelerate in line with pressure gauge sales, but I'm not modeling that benefit. Measurement control equipment, die cast, and other segments are all driven in large part by the Japanese automotive industry. They post decent results in the most recent quarter, and their results should track the Japanese automotive industry in the future. But they do not benefit from currency tailwinds like the pressure gauges and pressure sensor segments. Geographic split a currency tailwind. About half of Nagano's revenues generated in Japan, 22% in the USA, 15% in Asia, mostly China, 9% in Europe, and 3% elsewhere. The recent 25% depreciation of yen/USD is a large boon to Nagano's business. Depreciation versus the Chinese yuan, 20% and the euro, 7%, have been somewhat smaller, but still a solid tailwind. Not only does this depreciation mean more yen for every dollar, yuan slash euro of sales immediately, but improves Nagano's competitiveness going forward, as 2/3 of their PP&E is located in Japan, 20% in the USA, and balance in China. It is worth highlighting here as well that revenue growth is being driven by Asia, Europe, and others. Japan has stagnated since 2018. USA is only up 1%. It is likely that USA revenue in 2018 was benefiting from greater O&G activity that occurred in the year ending 3rd 31st 2022. Run rate, earnings, and downside case. In the table below, I lay out my forecast for the year ending 3rd 31st 2023, assuming that the business performs in the final two quarters exactly how it performed in the quarter ending 9th 30th 2022, adjusted for current exchange rates. In reality, there will likely be some additional revenue growth due to higher oil and gas activity. However, that additional revenue may be offset by the slowing global economy. Run rate analyzes the most recent quarter's results at current exchange rates. RR 25% is the downside GFC case, where a haircut the run rate case revenue by 25%. Similar peak to tough through decline seen during GFC, and decreased cash OPEX by 10% as well, similar to GFC as well. TEV and valuation. Nagano has a net cash position that is roughly offset by a net pension liability. Since 2016, Nagano's TEV/EBITDA multiple has fluctuated between 5.8x and 11.2x, with an average of 7.6x. The current market price implies 5.6x. Mean reversion to 7.6x would imply well north of 30% upside to fair value. Risks and mitigants. Risk 1. Nagano's overstreaming relative to their current mid-cycle earnings power. Global economy goes into a recession, hurting Nagano's cash flows, making it only optically cheap. Mitigant 1. Nagano currently trades at a reasonable 9x EBITDA in my GFC stress test scenario. During the real GFC, Nagano traded at more than 15x through EBITDA, applying a large margin of safety today. Risk 2. My returns are measured in USD, not yen. The yen may continue to depreciate and impair the dollar value of my investment, as 50% of Nagano's revenue is generated in Japan. Mitigant 2. I don't have a strong view on the future trajectory of the yen, but this is a risk that can be hedged. Risk 3. Japanese capital allocation is poor. Nagano has piled up cash and investments on its balance sheet over the past 15 plus years. When will I see my money? Mitigant 3. There's paltry dividend, but this is a real risk. The good news is that they have not destroyed capital with large acquisitions. The only semi-mitigant to this risk is the extremely depressed valuation. Catalyst: continued solid financial results driven by currency tailwinds, strong competitive positioning, and oil and gas activity. Thank you very much for tuning in, and see you next time. Write down, please, in the comments below what you